Right now, I mean, practically every retail CEO on the planet is slashing prices just to survive, dealing with this inflation-squeezed consumer.
Yeah, totally. It's a bloodbath out there.
It really is. The legacy playbooks are just out the window. And the entire sportswear sector is stuck in this brutal race to the bottom, right?
Yeah.
Just clearing out back rooms with endless, 30% off email blasts.
Oh, yeah. My inbox is full of them.
Right. But yet somehow a premium Swiss running brand just hiked their average selling prices by $25 a pair. They absolutely refused to offer markdowns, and they still saw their top-line demand skyrocket by over 26%.
It's pretty wild to see.
It's completely wild. So welcome to this Talk Tickers Deep Dive. Our mission today is to cut through the Wall Street jargon and deliver the key takeaways for you in under 5 minutes. We are unpacking the Q1 2026 earnings call transcript from On Holding. That's ticker ONON. The brand with those distinctive cloud-like shoe soles.
Yep, the ones you see literally everywhere now.
Exactly. But the real question is the hype around this premium running brand translating to real profits, or are they, running out of breath?
Yeah.
We are going to look at the exact numbers, analyze the management changes, and give a clear verdict on what it means for anyone considering the stock. So, okay, let's unpack this, because when you look at the raw data, the sheer velocity of what they just reported completely defies the current macroeconomic reality.
It really does. I mean, it is a staggering divergence from the rest of the sector. When we look at the Q1 2026 top line, On Holding delivered net sales of 831.9 million Swiss francs.
Wow. Wait, so in USD?
Translating that, you are looking at well over $1 billion in a single 90-day window.
$1 billion in a quarter. That's huge.
Right. But the absolute number isn't even the anomaly here. It's the growth rate attached to it.
Yeah.
They posted 26.4% growth on a constant currency basis.
Which means ignoring the fluctuating exchange rates, right? Just pure sales growth.
Yeah. Exactly, because even with significant foreign exchange headwinds baked into their reported 14.5% growth, the underlying organic demand for the product is expanding at a pace that legacy titans simply cannot model right now.
And doing that at $1 billion quarterly run rate is where the math gets incredibly hostile. I mean, scaling a business at 26% when you're a startup doing 50 million, that's one thing. Doing it when your denominator is already pushing 4 billion annualized is it's like trying to change the tires on a Formula One car while it's going 200 miles an hour.
Yeah, it's a great analogy. The friction is usually too high.
Exactly, because every new demographic you target introduces a massive risk of supply chain friction and brand dilution too. But the revenue isn't even the number that stopped me in my tracks.
No,
it's the margin profile, because top line vanity metrics are easy if you're just buying market share. But they reported a gross profit margin that jumped to 64.2%.
Which is astronomical.
It is. That's up more than 400 basis points, so 4 full percentage points from the exact same quarter last year. And their adjusted EBITDA margin hit a near record 21%.
Yeah, and just to put that into plain language for you listening, hitting a 64.2% gross margin and a 21% EBITDA essentially proves their pricing power is bulletproof right now.
Okay, break that down a bit more. What does that actually mean for the cash register?
Basically, for every shoe sold, On is keeping significantly more cash in the register before administrative costs. In footwear and apparel, breaking the 60% gross margin barrier places you in highly elite, almost like luxury house territory.
Right, like the Hermes of running shoes or something.
Pretty much. They are squeezing immense operational leverage out of their supply chain. It lets them drop a massive percentage of top-line revenue straight to the bottom line. They are completely bypassing the promotional traps that are currently gutting their competitors.
Right, but I have to push back on this a little bit. This flawless refusal to discount narrative that management is spinning. I mean, I hear the 21% EBITDA numbers,
right?
But if you look at their older inventory on third-party sites, or you dig into some of their broader wholesale distribution nodes, you can find markdowns.
Sure, you can find a few here and there.
Right, it's not completely non-existent. So are they really maintaining pure structural pricing power, or are they just highly effectively hiding their markdowns in the wholesale channel while keeping their direct-to-consumer facade pristine?
Well, that is the exact right question to ask, because channel stuffing and hidden markdowns have killed more footwear brands than I can count. But what's fascinating here is if you look at the unit economics detailed by the outgoing CFO, Martin Hoffman, the margin boost is fundamentally structural.
Okay, how so?
Over the last few years, On's average selling price, their ASP, has grown from around $145 to over $170.
So people are just willingly paying $25 more per shoe.
Exactly. They achieved that 400 basis point margin expansion because the volume of full price, premium tier product moving through their direct-to-consumer channel overwhelmingly dilutes whatever minimal liquidation is happening with legacy models.
I see, so it just washes it out.
Right. They aren't hiding markdowns. They've systematically engineered a product mix where the highest margin items are actually the highest velocity sellers.
Okay, let's pull the thread on that direct-to-consumer versus wholesale dynamic, because that's the mechanical engine actually driving the 64.2% gross margin. In Q1, their direct-to-consumer channel, the DTC, grew by 28.7%.
Yep, massive growth there.
And that actually outpaced their wholesale channel growth, which was, still 25.1%. And that spread, that 360 basis point delta between DTC growth and wholesale growth, I mean, that is the entire ballgame for an investor.
Precisely, because when a shoe goes from a factory directly to a consumer via On's website or their own physical stores, they reclaim the massive margin they normally surrender to a retail partner. Places like Foot Locker or Dick's Sporting Goods.
Because they aren't selling it to Dick's at a wholesale discount. They're getting the full retail price themselves.
Exactly. That margin recapture acts as a massive shock absorber for the entire business. The fact that their DTC channel is growing faster than their wholesale channel means their profit margins have structural, built-in room to keep expanding.
They dictate their own terms.
Right. They are dictating their own unit economics rather than being beholden to the purchasing whims of third-party buyers.
And they are getting incredible operational leverage on the administrative side, too. Their distribution expenses actually declined by a full percentage point to 10% of net sales. Management attributes that to aggressive global warehouse automation.
Yeah, the robots are definitely helping the bottom line.
Seriously. So you have a mechanism where the average selling price goes up to $170, the volume shifts heavily toward the highly profitable DTC channel, and the automated backend gets cheaper to run per unit. It creates this perfect flywheel.
But that flywheel only spins if the consumer actually desires the product across different global markets.
Right. Let's look at the geographic dispersion because the Asia-Pacific numbers are just wild.
The APAC region is acting like absolute rocket fuel for their top line right now. APAC grew over 61% on a constant currency basis.
61%.
Yeah, and for the first time, it crossed the threshold to represent over 20% of the company's overall business. They're no longer just a European and North American phenomenon.
They specifically highlighted South Korea on the call, right? Sales there more than tripled year over year. I looked into the real estate strategy they are deploying there, specifically the new standalone store they opened in Hanam.
Oh yeah, Hanam is a massive deal.
It's this highly sought after, incredibly affluent shopping district near Seoul. It's essentially ground zero for trend-setting consumers in their 20s and 30s. And management noted the store is already performing significantly ahead of expectations.
Which is a huge win for them.
It is. But what's crucial here is what those 20-somethings are actually walking out of the store with. Because On is aggressively pivoting away from just being, the quirky shoe you wear to run a 5K.
Yeah, this is the toe-to-head strategy that co-CEO David Alleman emphasized. And it is arguably the most critical pivot the company is making right now. In Q1, their global apparel sales surged over 50%.
Wow.
Apparel now makes up more than 10% of their entire DTC business.
Which is historically one of the most treacherous transitions in sportswear. I mean, we've seen Under Armour struggle for a decade to make their apparel culturally relevant outside of a gym. And we've seen apparel-first brands completely fail to engineer a credible sneaker.
It's extremely hard to do both well.
Exactly. Expanding into apparel while maintaining a 64% gross margin is incredibly difficult because apparel has far more sizing variables, much higher return rates, and massive seasonal inventory risk. How are they mitigating that friction?
Well, they are mitigating it by targeting a very specific demographic psychographic, which Alleman refers to as the movement class.
The movement class? I like that.
Yeah, it's a great term. This isn't just about selling a moisture-wicking shirt to a marathoner. The movement class is an ageless, affluent demographic that views health as a primary status symbol. They view premium sportswear as identity, not just utility.
So they're wearing it everywhere.
Exactly. When that consumer buys a $130 on running jacket, they aren't just wearing it on the track, they are wearing it to the airport, to the cafe, to the grocery store. It becomes their default uniform.
So it's essentially the Lululemon playbook,
Yeah.
but executed from a footwear-first origin rather than yoga-first.
That's a perfect way to look at it.
And to capture that identity market, your brand has to sit precisely at the intersection of high performance and high culture, which leads us directly to the Zendaya partnership, because this is where they are aggressively and successfully aging down their demographic.
Yes, the Zendaya effect is very real.
5 years ago, the on-holding stereotype was like affluent suburbanites in their 40s and 50s, the orthopedic adjacent crowd.
Right, the tech bros and the dads.
Exactly. But in Q1 2026, they explicitly noted that 18 to 24-year-olds dramatically increased their share of the customer base.
And you can map that demographic shift perfectly to intentional lifestyle product lines like the Cloud Tilt sneaker and that Zendaya campaign. That single apparel and footwear campaign generated over 20 million highly engaged views in the US alone in just a few weeks.
20 million views, that's absurd.
It acted as a massive cultural catalyst. And as a direct result, U.S. brand awareness officially crossed the 30% mark for the first time in the company's history.
Okay, that statistic right there is the ultimate bullish signal for the pipeline. Only 30% of the U.S. market is even aware the brand exists, yet they are already generating over $1 billion a quarter globally.
The runway to monetize the remaining 70% is just massive.
It's huge. But here is the critical distinction, and here's where it gets really interesting. You can buy all the celebrity partnerships and cultural cachet in the world, but if the underlying product innovation doesn't back it up, you just become a fashion fad that dies in 36 months. Right. We have to talk about the light spray technology because this completely alters the manufacturing unit economics.
Oh, light spray is genuinely disruptive. It isn't just a marketing gimmick. It is a fundamental re-engineering of how footwear is actually manufactured.
How does it actually work compared to normal shoes?
Well, for context, in a traditional running shoe, you have dozens of disparate pieces of fabric, mesh, and plastic. All of those components have to be manually cut, stitched, and glued together by human hands on an assembly line.
So expensive.
It is incredibly labor-intensive, it creates massive material waste, and all of those glued seams add weight and potential friction points for an athlete.
All right, well, I dug into the patent mechanics of light spray, and the efficiency gains are staggering. The robotic arm isn't just like 3D printing plastic. It's layering a continuous, lightweight synthetic filament that bonds thermally.
Yeah, it literally sprays the shoe into existence.
It completely eliminates the gluing phase, which historically bottlenecks production lines and requires massive ventilation infrastructure in factories. They are spraying a shoe from filament to finish in under 3 minutes. No glue, no seams, practically zero waste.
And the performance validation is already there too. Helen Obiri wore a light spray prototype at the London Marathon and posted the second fastest time ever recorded in a female-only marathon.
That's incredible validation.
It is. But the real breakthrough isn't just the elite performance, it's the immediate commercialization of that performance. Typically, a sportswear titan will build a halo product for the Olympics, right? Like a super shoe that costs $1,000 to make, and it's purely a marketing expense.
Right, like concept cars.
Exactly. The average consumer can't buy it, or they only release a highly limited batch of like 50 pairs.
Exactly. But On took this robotic thermal bonding technology, built a 30-fold capacity expansion factory in Busan, South Korea, and then literally put the robotic manufacturing cell in the window of their physical retail stores.
It's brilliant retail theater.
In the opening week of their new Boston store, customers could stand on the sidewalk, watch the robotic arm spray the shoe, walk inside, and just buy it. The transcript noted that light spray shoes accounted for nearly 20% of all footwear sales in that Boston store's opening week.
20%? That's massive for a brand new technology.
And they're already selling hundreds of pairs a day online. They took an Olympic-tier performance innovation and instantly monetized it at scale.
Well, if we connect that localized, automated manufacturing capability to the broader financial picture, it illuminates a concept that Martin Hoffman introduced on the call. And it's arguably the most vital metric for long-term investors. He referred to On's current demand profile as a loaded spring.
A loaded spring. That phrase really stood out to me as well. Break down the financial mechanism behind that, because on the surface, the data point he used to justify it actually sounds like a negative.
It does sound counterintuitive at first.
Yeah, because he mentioned that demand measured by physical foot traffic in their retail stores and digital traffic on their website is growing faster than their actual sales volume. Doesn't that mean their conversion rate is dropping? Like people are walking into the store, looking at the $170 price tag, and just walking out without buying.
Well, in the hyper short term, a retail analyst looking solely at quarterly conversion rates might flag that as a headwind. But if you understand the life cycle of a premium brand, a dropping conversion rate driven by a massive spike in top-of-funnel traffic is actually the ultimate bullish indicator.
Because it means more eyeballs are on the brand.
Exactly. It means you have successfully captured the aspirational curiosity of a massive new audience, that 18 to 24 demographic, the fashion crowd drawn in by Zendaya, the sneakerheads looking at the light spray tech. They are entering the ecosystem. They are window shopping the brand.
But they might not have the wallet for it yet.
Right. They might not have the discretionary income to buy a $170 cloud tilt on day one. But the desire is captured. The spring is compressed.
So it's an unmonetized pipeline.
As the brand continues to expand its offerings, maybe, introducing an entry-level apparel piece, a lower-priced accessory, or simply as that younger demographic ages into higher-earning brackets, that traffic will inevitably convert.
Exactly. It represents future revenue that is already inside the tent.
They are willingly accepting a lower short-term conversion rate in exchange for massive long-term cultural dominance.
Absolutely. And that unmonetized pipeline of stored traffic isn't just a theoretical marketing concept either. It is the exact mathematical justification management is using to aggressively raise their forward guidance for the rest of the year, which transitions us perfectly into how they're modeling 2026. Let's get into the management guidance, because forward guidance is where the C-suite really puts their credibility on the line.
Always.
For the full year 2026, On Holding reiterated their target of at least 23% constant currency net sales growth. They are aiming for 3.51 billion Swiss francs. But the real story wasn't the top-line reiteration, was it? It was the profitability forecast.
Yes. They actually raised their full-year margin outlook. They now expect gross margins to hit at least 64.5%, and their adjusted EBITDA margin to come in between 19.5% and 20%.
And this is where the sheer strength of their unit economics becomes undeniable. Because raising profit guidance typically implies a deflationary cost environment, right? Things are getting cheaper to make.
Usually, yes.
But On Hold is facing the exact opposite in a highly specific, highly volatile area of their supply chain. We have to look at the geopolitical tariff situation, because management explicitly stated that this increased record high margin guidance includes absorbing a 20% incremental tariff rate from Vietnam.
Yeah, that part of the call was stunning. It's a masterclass in operational leverage.
Exactly. And I want to make sure the math lands perfectly for you listening.
Yeah.
Imagine you are running a multi-billion-dollar logistics network, and macroeconomic shifts suddenly dictate that your primary manufacturing hub in Vietnam gets slapped with a 20% export tariff.
Ouch.
Right. The legacy retail playbook offers two miserable choices. You either pass that 20% cost directly to the consumer by jacking up the price of the shoe, which destroys demand, or you eat the cost internally and your gross margins completely collapse.
Lose-lose situation.
But On is taking a 20% hit on their Vietnamese cost of goods sold. They are not artificially raising retail prices beyond their normal premium cadence to cover it, and they're still telling Wall Street their overall profit margins are going to expand to 64.5%. How does the math actually support that?
Well, it works because of that margin recapture mechanism we discussed earlier. When they shift a larger percentage of their total sales volume out of wholesale and into their direct-to-consumer channel, they reclaim the 25 to 30% margin they normally surrender to the retailer.
Oh, wow. So that just pays for the tariff.
Exactly. That massive margin recapture completely neutralizes the 20% Vietnamese tariff hit on the back end. Furthermore, their rapid scaling of higher margin categories, specifically apparel and premium lifestyle silhouettes, mathematically dilutes the tariff impact on the blended average.
So they've essentially built a fortress.
They have engineered a corporate structure that can absorb a massive geopolitical macroeconomic shock and still deliver 20% EBITDA margins to the bottom line. It is the rarest trait in current retail. True structural resilience driven by pricing power.
But amid all this operational excellence and margin expansion, there was a massive elephant in the room on the earnings call. A highly significant shift in the C-suite architecture.
Yes, the leadership changes.
Martin Hoffman, who served as the CFO and the outgoing CEO, is leaving the company after 13 years. 13 years in the hyper-competitive sportswear industry is an absolute eternity.
It really is.
Hoffman was the financial architect of On's hyper-growth phase. He navigated them through their IPO And he built the margin structure we've been analyzing today.
His departure is a major inflection point. Frank Fuse is stepping in as the new CFO, and the original founders of the company, Kasper and David, are taking over as co-CEOs. Now, as an investor analyzing governance, whenever you see the disciplined financial architect exit the building and the visionary founder step back into the dual CEO role, a very specific alarm bell goes off.
Right. Founder syndrome. The immediate fear is that the founders are returning to push a grow-at-all-costs mentality, that they're going to sacrifice the 64% gross margin to chase market share, flood the wholesale channels, start discounting to boost the top line, and try to appease shareholders who want to see the stock price double tomorrow. Do we see any evidence of that strategic shift in this transcript?
If we connect this to the bigger picture, it is the most vital risk factor to assess, and management was acutely aware of that exact narrative. They used the call to aggressively push a narrative of absolute continuity.
They got out ahead of it.
Very much so. Kasper explicitly stated on the record, "We are not pursuing growth at any cost." They pointed out that as executive chairman, both founders have been deeply operationally involved for years. They are the ones who drove the retail expansion, the apparel pivot, and the light spray innovation that are currently yielding these massive margins.
The message to Wall Street was unequivocal. They are not going to start selling cheap, diluted versions of the Cloud Surfer in discount department stores just to hit an arbitrary revenue target. They view the premium brand equity as their single most valuable asset, and they intend to protect it above all else.
Yeah, no 30% off sales anytime soon.
Exactly. Which brings us to the ultimate verdict on this Talk Tickers deep dive. We've torn apart the billion-dollar quarterly run rate. We've analyzed the mechanics of the 400 basis point margin expansion. We've looked at the margin recapture of the DTC channel offsetting the Vietnam tariffs, and we've evaluated the C-suite transition. So what does this all mean? What is the definitive signal here?
If you look at the totality of the data, the signal is highly, highly bullish. On Holdings Q1 2026, results demonstrate a company operating from a position of profound structural strength. They possess the pricing power to hike ASPs to $170 without denting demand, the technological innovation to fundamentally alter manufacturing costs with light spray, and the cultural momentum to capture the highly lucrative 18 to 24 demographic.
Yeah, for anyone holding O&On or modeling the stock, the actual takeaway is that this company is successfully executing one of the most difficult maneuvers in commerce. They are graduating from a niche, hardcore performance running shoe, the kind that was strictly the domain of triathletes half a decade ago, into a globally dominant lifestyle and apparel brand.
And doing it profitably.
Very profitably. That loaded spring metric is the key. The fact that their top-of-funnel brand curiosity is growing even faster than their 26% sales growth means they have a massive unmonetized pipeline of future revenue just waiting to be converted as they build out their apparel and lifestyle offerings. They aren't just surviving the retail downturn, they are actively taking market share while expanding their profitability.
But to maintain our objectivity, we have to look at the horizon. This raises an important question, one that will define On's trajectory over the next 5 years.
What's the main risk you see?
Well, as they rapidly expand into buttery soft yoga apparel, as they push lifestyle sneakers like the Cloud Tilt, and as they court that younger, fashion-forward demographic with Zendaya, the question is no longer whether On can sell high-margin running shoes. The transcript proves they can.
Right.
The existential question is, can On displace the legacy titans, the Nikes, the Lululemons, as the default everyday uniform for consumers worldwide without diluting the premium high-performance edge that made them famous in the first place?
Oh, it's the ultimate tightrope walk. Because the exact moment the hardcore marathon runner feels like the brand has devolved into just another fashion accessory for the movement class, the underlying authenticity dies.
And you can't buy that back.
Never. And in the sportswear sector, authenticity isn't just a marketing buzzword. It is the foundational pillar of pricing power. Once you lose the performance credibility, that 64% gross margin vanishes, and you drop right back into that brutal race to the bottom with everyone else.
It is a delicate balance for sure. But based on the execution of the light spray technology, they seem deeply committed to ensuring their cultural relevance is anchored by genuine, elite-level innovation.
So we zoom back out to that broader retail landscape. You have the legacy brands slogging it out in a margin-crushing promotional war, fighting for pennies on the dollar just to clear inventory. And then you have On, operating in an entirely different paradigm. They are raising prices, expanding margins, capturing cultural zeitgeist, and spraying elite performance footwear with thermal bonding robots in the windows of their retail stores.
It's quite a contrast.
It really is. They have built a financial engine that seems highly capable of going the distance.
So keep a close eye on how that loaded spring of demand converts in Q2, and definitely watch that DTC growth spread. That's the breakdown for the Stock Tickers Deep Dive. We'll catch you on the next one.